Welcome to FT Markets. There's been a bit of a rally on Asian markets today after all the gloom of the past couple of weeks, but I don't think many people think it's over yet. With me to discuss what's coming up is James Kynge, our emerging markets editor. James, there's all kinds of explanations for what's been going on, all driven by China. It might be communications, it could be structural malaise. What do you think is behind it?
When we look at the important structural issues, the single biggest issue facing the Chinese economy is the outflow of capital. And we have a chart here that shows the magnitude of these outflows. This is from the Institute of International Finance. And as we can see, in 2015, there was total outflows from emerging markets of about 735 billion US dollars. But overwhelmingly, here in the blue, this was outflows from China. That's 676 billion came out of China. Now, what we can also see from this chart is that the IIF thinks that this trend is not going to stop. This year we're going to be in a similar situation with nearly about 600 billion US dollars flowing out of China. So obviously this is going to have a continued depressant effect on the Chinese economy and add downward pressure onto the renminbi's value.
Yeah, I mean, this is next year again, as you say, we've got a huge net outflow from emerging markets. Take away China and there's actually a bit of a recovery, but it's really overwhelmed by the amount of flows coming out of China. How does that feed through? You would expect the government in Beijing say that they are no longer targeting the renminbi against the dollar, that they're targeting their trade basket, and that is holding fairly stable. But for businesses and for people in China holding dollar debts, it is the dollar rate that often matters most. So how's that going to feed through into the currency, into the business and the economy?
See, a lot of people look at this through slightly the wrong prism, I think. A lot of people see the renminbi's value against the US dollar and other currencies as something which is dictated by the People's Bank of China. But actually what's driving the renminbi down is forces beyond Beijing's control. And that is primarily that people in China, companies in China, and investors want to get their money out. The reason they want to get their money out is because there is very little to invest in China that gives you a positive return. And the other reason they want to get their money out is because, as we stand, Chinese companies have about 1 trillion US dollars in dollar debt, all of which comes due this year. So they're going to have to repay that as the year stretches forward. And obviously that's going to have a negative impact on outflows, and that will keep pressure on the renminbi strong, I would say, throughout the year.
Okay, we see what the IIF thinks. There are some doomsayers around who are a bit more gloomy. Do you think, and their argument would be that once these flows get going and once individuals and companies begin to realise that if they don't change into dollars soon, they're going to be far worse off as a result of delaying. Do you think we're near a tipping point, or do you think the authorities have the firepower to keep it under control?
The authorities certainly have the firepower. China's foreign exchange reserves are about 3.3 trillion US dollars at the moment, and they are burning through it very quickly. But they have said that they want to keep the renminbi's rate stable, and I think they will use hundreds of billions of US dollars in order to do that. But that doesn't change the fact that structurally the pressures are all downward. They're all towards this huge outflow. And sooner or later, the PBOC has to recognize that. It'll try to do so in a smooth and orderly fashion. But if you ask me, they have to recognize that the laws of gravity are immutable.
Plenty to watch there then, James. We will certainly be keeping an eye on how those capital flows progress and how investors and the Chinese people react.